How do you do, ladies and gentlemen? I'm your host, Seth Julian. Welcome you to today's briefing. And this busy chart shows us a great deal of information, so break it down and see what we can understand from this. The candlesticks going up represent the price of gold, traded on the New York Mercantile Exchange in New York, COMEX Gold. The bright yellow line is the current U.S. interest rate. Notice it's just recently taken a jump from 4.5% to 4.75% last Wednesday. The Federal Reserve raised its lending rate to the banking system by 0.25%, 25 basis points. And finally, the orange line is the U.S. dollar index. That's a relative value index of the U.S. dollar measured against 6 other currencies. When it is down, the U.S. dollar is weak, and when it's up, the U.S. dollar is strong. So what do we learn from this? We learn that the dollar index is almost perfectly inversely correlated to the price of gold. As the dollar weakens, gold goes up. As the dollar strengthens, gold goes down. And this phenomena gels completely at this point in time, the middle of November. That's where the relationship, because the correlation coefficient, as we like to say in statistics, reaches its maximum amplitude, and that would be -1, almost completely 100% inversely correlated. So we see that as the dollar gets stronger, gold goes up. As the dollar gets stronger, gold goes down, inversely correlated. So what we want to watch is the continued strength. The dollar has gained just from the beginning of February till now, which is just barely a week, a little over a week. And it's gained, I can tell you exactly how much it's gained. From the index, it's gone up a little over 4.38% in very little time, in 7 days. So that explains the decline in gold in those same 7 days of 3.85%. Not only is it nearly completely inversely correlated, it seems the rates of decline and rise are similar. So as the dollar strengthens, gold weakens. And as interest rates rise, so too does gold, apparently. The interest rate rise is not correlated with the dollar with strength of the dollar index. So that's an interesting phenomenon. Interest rates are correlated with the price of gold, not correlated with the strength of the dollar, and the strength of the dollar and gold are inversely correlated. So, ladies and gentlemen, those are 3 ways to look at the gold price. We are still holding our trade that we entered into at about 1872. We can see that it attempted to penetrate and did penetrate the 61% Fibonacci retracement level at 1943, stayed there for 1 to 3 days, and then receded back and took a dip actually below the 50%, but that recovered from that quite quickly. We think, and this is speculation and therefore we could be wrong, but we are also on the side of the large commercial speculators in the red line on the bottom, the Commitment of Traders report, who are net long. So the large commercial speculators are net long. We are also continuing to maintain our long position in gold that we entered in 1872. And that's how we see it, ladies and gentlemen, gold continuing its move up. That's going to do it for now. I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Khalas for now.